Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I'm going to describe about debt mutual funds versus equity oriented mutual funds while blindly relying on broker capital gain reports can lead to incorrect ITR filing. Introduction. Income tax return ITR filing is one of the most important financial responsibilities for every taxpayer. However, many investors can make a common mistake by relying solely on the capital gain report provided by their broker or investment platform without understanding how different mutual funds are taxed. This can lead to incorrect reporting of income, wrong tax calculations, notices from the income tax department, or even payment of excess or deficient tax. Understanding the distinction between debt mutual funds and equity oriented mutual funds is therefore essential for accurate tax compliance. Understanding equity-oriented mutual funds. Equity-oriented mutual funds are schemes that primarily invest in shares of listed Indian companies. Since these funds maintain the prescribed level of equity exposure under the Income Tax Act, they receive favorable tax treatment. Capital gains from these funds are generally classified as short-term capital gains (STCG) or long-term capital gains (LTCG) based on the applicable holding period prescribed under the law. Tax rates for equity-oriented funds differ from the other asset classes, making it important for investors to correctly identify the nature of the mutual fund before filing their return. Understanding debt mutual funds. Debt mutual funds mainly invest in fixed income securities such as government securities, treasury bills, corporate bonds, commercial papers, certificates of deposit, and money market instruments. These funds generally carry lower market volatility than equity funds but follow different tax rules. The taxation of debt mutual funds has undergone significant changes in recent years, and the applicable tax treatment now depends on factors such as the date of investment, date of redemption, and prevailing provisions under the Income Tax Act. Therefore, investors should not assume that debt funds receive the same tax treatment as equity funds. Why broker capital gain reports may not always be correct. Broker capital gain reports are generated using the data available in the broker's system. While they are useful as a reference, they may not always classify mutual fund transactions correctly according to the latest tax provisions. Some reports may fail to distinguish between data oriented and equity oriented schemes accurately, while others may not fully incorporate amendments introduced in recent finance acts. Acts. Corporate actions, mergers, switches, bonus units, segregated portfolios, or incomplete transaction histories can also affect the correctness of these reports. Common reasons for incorrect ITR filing. Many taxpayers simply download the broker's capital gain statement and directly enter the figures into their ITR without verification. This can result in incorrect classification of gains as equity or debt, wrong calculation of short term or long term capital gains, incorrect tax liability, mismatch with annual information statement, AIS, tax information statement, TIS, or other records, possibility of receiving notices from the income tax department, payment of excess tax or underpayment of taxes, both of which may require rectification later. Importance of verifying mutual fund classification. Before filing your ITR, always verify whether each mutual fund is an equity oriented fund or a debt mutual fund. Check the scheme information document, SID, fund fact sheet, asset management company AMC disclosures, and applicable tax rules. Even if two funds appear similar, their tax treatment may differ significantly based on their investment pattern and regulatory classification. Cross check with official records. Apart from your broker's reports, taxpayers should compare transaction details with annual information statement, EIS, tax information statement, TIS, consolidated account statements, CAS, AMC transaction statements, DMAT account reports where applicable, bank account entries for redemption proceeds. Cross-verifying these documents help identify discrepancies before filing the return and reduces the chances of future tax notices. Consult a tax professional or complex transactions for complex transactions. If you have multiple SIPs, systematic withdrawals, SWPs, switches between schemes, dividend reinvestment, grandfathering provisions, or investments made before and after changes in tax laws, consulting a chartered accountant or qualified tax professional can be highly beneficial. Professional guidance can help ensure that capital gains are calculated correctly and reported in the appropriate schedules of the income tax return. Best practices for investors: maintain proper records of every purchase and redemption transaction, preserve account statements, download updated tax reports, verify mutual fund classifications each financial year, and never assume that software generated reports are error free. Reviewing your capital gains carefully before filing your ITR can save time, money, and unnecessary compliance issues in the future. Conclusion: broker capital gain reports are valuable tools, but they should be treated as reference documents rather than the final authority for tax filing. Since debt mutual funds and equity oriented mutual funds follow different tax rules, taxpayers must verify the classification of every investment before reporting capital gains in their income tax return. Spending a little extra time on verification can help avoid incorrect tax computation, departmental notices, penalties, and unnecessary stress. Accurate reporting not only ensures compliance with tax laws but also provides peace of mind during the assessment process. Disclaimer: this article is intended solely for educational and informational purposes. Taxation of mutual funds is governed by the provisions of the Income Tax Act, applicable finance tax, CBDT notifications, and amendments in force for the relevant assessment year. Tax rules may change over time, and their application depends on individual facts and circumstances. Investors should verify the latest legal provisions and consult a qualified chartered accountant or tax advisor before filing their income tax return or making any financial or tax related decisions. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.